So I would say, maybe 1 in 3 chance for the September rate cut. If we don't get it, the markets will be disappointed. But having said that, Julia, there's so much cash sitting on the sidelines, sitting in the market right now, that, from a liquidity perspective, it's not like the markets are dying for liquidity. We have too much.
Chris Whalen, chairman of Whalen Global Advisors, author of the Institutional Risk Analyst blog, investment banker, the best independent analyst out there on Wall Street, and author of multiple books, including the second edition of Inflated Money, Debt, and the American Dream, which is now out, and the audiobook is coming out in just 2 weeks. And Chris, friend of the show, someone we look forward to having on every month. It's great to see you, and thank you so much for taking the time to join us from California this morning. Really appreciate it.
Yes, good morning. We're slumming at Terrania, which is one of the most beautiful resorts in the United States. It's due west of Los Angeles.
It looks
next
gorgeous.
To Manhattan Beach.
I could kind of see the palm trees through the curtains earlier when we were getting set up with the shot.
I'm a little sunburned. I'm hanging out with the California mortgage bankers. So it's what we call the Western Secondary Conference, which is basically people who work in the industry and then sell loans into the investor market. That's how you get a mortgage.
Got it. So, well, I bet you're going to get an interesting pulse as to what the folks are saying out there. And I'm excited to hear more on that. But Chris, I feel like every time I have you on, I always say, well, so much has happened. Well, we've gotten a lot of data points since you and I last spoke. Some interesting developments at the Federal Reserve. So can we just start with the big picture, what that looks like for you today? Has your outlook shifted or changed since we last spoke? And as you know, you can take all the time you need to set the table when it comes to that big picture view.
Yeah, sure, Julia. We have told our clients that we were doubtful that there would be rate cuts in 2025. The fact that Governor Kugler stepped down last week has changed the mix a little bit because now there's an open spot on the committee. I think it means that Jerome Powell will leave when his term as chairman is finished, if not sooner. And Donald Trump is going to get to start changing the central bank. His nominee, Steve Miran, has written pretty specifically about the things he would like to see at the Fed. I've always wanted to see the Fed's progressive aspects changed, but I think we're going to see even more radical changes than that. I think probably you're going to see a rate cut in September, it sounds like. Although, again, we had a bad inflation number this morning, and you do need a majority of the committee to get a rate cut. So I'm not sure that they're going to have a majority in September. There's a big question mark here. A lot of shops are out with multiple rate cut predictions, by the way, for this year. So I think the question mark is the best way to describe it, Julia.
Okay, so the question mark being that you're not sure, even though a lot of folks are expecting a rate cut in September, you're not sure. Yeah. Can you elaborate a bit more on the reasons? Are you, maybe put a probability on it, but I want to hear more of the reasons as to why it's not the case, because it is interesting. You're right. You're seeing more and more come out, but I want to hear the thought process for why not.
You have to have a majority on the FOMC to change policy. I think that some of them have already spoken. Waller, and Mickey Bowman both dissented last month. Mm-hmm. So they are clearly a vote for rate cuts. Anybody who wants to be picked as chairman by President Trump obviously is going to say they want to cut rates. But the rest of the committee is not there. Alberto Musalem, for example, one of the Reserve Bank presidents, has been speaking, in very cautious terms. And I think there are several other governors who are basically on the fence. So I would say, maybe 1 in 3 chance for the September rate cut. If we don't get it, the markets will be disappointed. But having said that, Julia, there's so much cash sitting on the sidelines, sitting in the market right now, that, from a liquidity perspective, it's not like the markets are dying for liquidity. We have too much. We put out a piece yesterday about SoFi. SoFi is the best performing bank in the United States. It's outperformed Bitcoin by threefold this year. Yeah. So what we've told our readers is buy the enablers. Don't buy the coins. Buy the enablers. There's more leverage there.
Interesting. Just looking at the prediction markets, Kalshi, Fed decision at September, 80% probability for a 25 basis point cut. That's what folks are at least expecting. 14% think they'll maintain.
They may be disappointed.
Yeah. I mean, let me tell you something. I love contrarian takes on this channel. So anything that's different. I do want to keep on the topic of the Fed before I move off of them. You mentioned this expectation of some radical changes at the Fed. You mentioned that you always want to see the Fed move. I guess you wanted to see them move away from being more progressive. Can you elaborate a bit more on how you're thinking about the Fed, what changes could look like? And I'd love to get your reaction too on Steve Miran, for example.
Well, the Fed has, gone from being a decentralized kind of 19th century central bank when it was first created in 1913, but to being a very progressive economic planning agency. The Republicans, and I think particularly Donald Trump and Steve Miran, really want to rein in the mission creep of the Fed that gets them into all sorts of other areas of policy other than what Congress has mandated, which is employment and price stability. Those are the two things they're supposed to watch. And so I think that what they would do in terms of governance is bring the Fed back much more to where it was prior to, say, 1929, when the Fed folded its arms and said, gee, we can't help you. That's part of the reason why Franklin Roosevelt created all of these new parastatal entities, Fannie Mae, Freddie Mac, the Federal Home Loan Banks, the Reconstruction Finance Corp. All of these federal entities were created because the Fed basically refused to get involved. They said no. They didn't want to get into housing finance, for example. So that's why I think the Republicans would like to wind the clock back in many respects and get the Fed really focused on monetary policy only. No more economic planning, no more worrying about tariffs and other non-monetary factors. And Steve Miran, I think, is very much in keeping with that agenda. If you look at his writings, he's been very, I think, forceful and way, way outside of the consensus. And the economic profession, of course, are going to throw a hissy fit because many of them make a living predicting what the Fed is going to do or not do. But I think a lot of that could go away if President Trump has his way.
The question often gets thrown out there, like, a lot of folks who come on this channel, they think the Fed is political. Do you think that we could get back? Well, I don't know what your views are on that, but do you think we could get back to like a more independent Fed?
Yes. The way you do that is you get rid of the Board of Governors in Washington. I know they're building a new palatial headquarters, but if you got them out of Washington, created 3 new reserve banks in the West where we obviously need them, you would turn branches into full-blown reserve banks. And then you'd have 12 or 15 reserve bank presidents as the Federal Open Market Committee. And that would be it. You rotate the chairmanship and you get them out of the political domain. And I think it would be good for the country. Now, can they act independently given the federal budget debt? No. The deficit mandates everything. The Fed is the tail on the doggy right now, Julia. The dog is the U.S. Treasury. And that's the reality. You can't have a discussion about Fed independence if you're out basically borrowing $1 trillion every 3 months. That's not going to work.
Yeah, you're beholden to it because of our fiscal picture. I mean, I don't know. Does that ever change? Is there a way out of that?
Well, if we can get people in Congress to actually focus on fiscal issues, they don't want to do that.
Yeah, they won't.
America, I talk about this in my book. Americans don't like to pay their bills. Going back to the inception of our country, we have always preferred inflation to raising taxes. That's a constant throughout the history of the country. And the war made the dollar the reserve currency of the world, but that was an anomaly. That is not a normal state of affairs. In fact, I'm getting ready to start work on a new book on gold for next year. And what we're going to describe is how gold is going to once again become the chief reserve asset of the world. So when I hear Steve Miran say he wants to sell all of our gold to drive the dollar down, that tells me he doesn't understand. The way you make paper cheaper is by buying gold. You sell paper, you buy gold, the value of the paper goes down. We learned this in the Great Depression, by the way. That's what Franklin Roosevelt did when he devalued the dollar.
Elaborate a bit more on that, though. Like, I take it you're not in favor of his ideas there, but I want to hear more on the relationship with gold and the dollar. Is this also like getting back to just more sound money?
It's getting back to a reference point that is not dependent on politics. A fiat currency is an entirely political phenomenon. There's no value. It's kind of like a crypto asset. There's no inherent value in it. Dollars, at least, you can finance and you have carry. If you buy a Treasury bond, it has income. But I think what we're going to see is that Russia, China, most of the other Asian nations, the Europeans, where are they going? They're going back to gold as their chief reserve asset for their own central banks. Mm-hmm. To me, the obvious trade here is for the U.S. to be selling paper, in a modest amount and buying gold to add to our own stocks. And again, the reason you do this is to recognize the inflation that's out there, Julia. The price of gold has not gone up enough to really compensate for the inflation we've seen over the last 20 years, right? Mm-hmm. It's only been since 2015 that gold really started its current ascendance. So I think if I'm the U.S., if I'd like a cheaper dollar to perhaps force the trade deficits down and rebalance American consumption, I want to be a buyer of gold, not a seller of gold. I think Mr. Miran's got this wrong.
Gold prices have been breaking all-time highs this year, but price appreciation isn't the only way to profit from owning gold. You can earn a yield on gold paid in gold without selling your gold or silver. Unlike dollar yields that can be slashed or even go negative, a yield on gold paid in gold means more ounces in your account every month, not paper. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities for you to earn 4% on gold, paid in gold in their marketplace. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning a yield in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. So with gold then, I take it it's still early innings for gold. I'm just looking at it right now. It's $3,383.60 per ounce. That's just like where it is right now. It's been like on a tear the last couple of years. And a lot of folks on this channel, they like gold, they own gold. So I take it based on like inflation, it's still got a lot of room to run then.
Not just inflation, Julia. Think about what the allocation to gold is in most U.S. portfolios.
I don't know. What is the percentage? Not that much, right?
Less than 5%. Mm-hmm. So even if allocations to gold in the United States were to double, let's say it gets up to high single digits, that would have an enormous impact on the price. And I think, remember, Americans have been brainwashed going back to the Great Depression and the New Deal. The U.S. government has consistently tried to marginalize gold and have all of the focus on the dollar. But that only works if we behave ourselves. If we add a lot of debt on top of a fiat currency, it doesn't work. And this is unfortunately the result of our politics. We've had the politics of plenty. Anytime we wanted, we would just go out and borrow the money. This is the result of war. It's a distorted worldview that our government has had, really going back 100 years. So I think that we have to realize that the rest of the world is voting with their feet. And they're saying, no, we're not going to have the dollar as our chief reserve asset anymore. We are, in fact, going to start to move to other currencies and to gold. You could also see other metals in the mix. I'm not a big fan of silver. I still think silver is the poor stepchild in this conversation. But, there are other metals that are extremely valuable, palladium and the rest of them. And you could see them figure as well. But gold is still going to be the chief hard money asset, I think, for reserve purposes. And remember, banks can hold it in vault now as capital under Basel since the beginning of July. That's a big change. You can use gold as collateral in transactions. That was not allowed for half a century after Franklin Roosevelt.
And I take it, what is your allocation of portfolio? Like, what are you at, like 10% or?
No, I'm close to 10. I use futures. I'm mostly speculating on the price. I'm not a big enough collector to actually have a lot of physical. I don't discourage people from having physical, but if you have a lot of it, you have to put it in a secure repository and pay for it. True. Having said that, gold was always seen as a asset with no income, but that's not true today. If you have gold in the vault, banks will lend against it. You can borrow up to 90% of the gold's value.
Yeah. All right, let me shift topics and just kind of go through a couple of other developments in recent weeks. I want to get your reaction to the jobs report that we saw come out earlier this month, the downward revisions, like what's happened in the labor market. Normally we have you at the top of the month. We're on it's Tuesday, August 12th. So normally this would be like a question I would have posed to you like that Monday recording. Right. What was your reaction or what's your take on the state of the labor market?
I always take these statistics very, very much with a grain of salt because you have to wait for at least 6 months to see what the revisions are up and down. Big picture, Julia, I don't think the government should be gathering this data. We created the Bureau of Labor Statistics in the 1880s when the folks in Washington had no idea what was going on in the country. So they were anxious and demanding to get better data. Even by the time we got to the 1920s and 30s, we still didn't know what was going on in the country. The Bureau of Labor Statistics does, a reasonable job of aggregating all of this, but why are we even using the federal government for this sort of stuff? We could have universities, private entities gathering this data and publishing it. And there's absolutely no reason to have the federal government doing this. But remember, the economist profession has created this kind of ecosystem for themselves around government data. And I think that's one of the areas that I would hope the Trump administration would take a hard look at. Do we need to have the federal government putting out data that, frankly, is quite volatile? If you look at the revisions in this data series, it's all over the place. So I don't really look at it as a guide for investing or a guide for economic analysis because I know it's going to be revised.
And then we had the inflation report this morning, CPI.
Yes.
Yeah. What's your take there?
It's not helping you with the rate cut conversation. That's really the thing. Why is the economy still doing relatively well? Because we have a lot of liquidity. We have more liquidity sloshed around the financial markets than I can remember at any time in my professional life.
Yeah. So why is that? Why is that?
Because the central bank injected huge amounts of liquidity during COVID, and it's still here. That's the remarkable thing. If you look in the credit markets, banged up assets, defaulted assets are still changing hands. And you ask yourself, why are people buying this stuff? And the answer is it's a trade more than an investment. I think that until we, this is one reason why Governor Waller wanted to continue shrinking the Fed's balance sheet, because it's very clear that we still haven't gotten down to what you would call the minimum amount of liquidity that's required in the system for it to function properly. We don't know what that number is. That's a mysterious model output from the Fed. But I think that for my money, I'm not expecting the markets to trade off anytime soon. My one worry, though, Julie, I will tell you, is the random factor. Out there somewhere is a crypto platform that nobody's ever heard of that is going to implode. And when it does, it's going to scare the hell out of everybody and you're going to see a sell-off. But to me, you know what? In this hyperbolic market we've been living with for the past few years, it's probably a buying opportunity. I mean, you see this with NVIDIA, for example. There's all kinds of people describing why that company is going to collapse tomorrow, right? It's not going to happen. If anything, that stock's going to go higher. I'm long NVIDIA. I've been in and out of it many times.
Yeah. Okay. So as it relates to markets, then I want to get your perspective there. Like, still buying opportunities? Like, I guess the party can keep going.
The banks have rebounded fully from the sell-off in April. They're back to where they were last year at the highs in many cases. The rank order of the top performing institutions that I track has changed rather dramatically. But, having said that, I think managers are loading up on these public stocks because they want liquidity. They're not really ready to put all of their eggs in the private investing basket, although now, Americans can put private assets in their 401ks. I'm not so sure that's a good idea. But, like I say, the inflation aspect of markets today, I think, is the most dramatic. There's really no catalyst out there for a major deflationary sell-off unless we scare everybody. Remember, the systemic event is defined by surprise.
Yep.
If something happens that nobody expects, then they're going to react.
Yeah, you can't predict that either.
Nope.
On the asset prices, let me think how I want to ask this. Inflation, like all roads lead to inflation. Inflation is a story. It's like what your book is inflated.
The American pastime.
Yeah. Does that also explain what we've seen in markets? Like, is that like an inflation hedge then? Why are we seeing
equities
markets
traditionally have been an inflation hedge, and real estate. The difficulty now is that there's been a lot of changes in the use cases for real estate. So, and the politics. You see the situation in New York with Zohar Mamdani. I don't think he's going to win, by the way. But let's say he wins in New York. No, I think they're going to get behind Cuomo. I think Cuomo's going to eke it out.
Do you think Eric Adams is going to drop out then?
He should. I don't think he can. I don't think the black community would let him do that. But I do think that if you put the more moderate Democrats together with the 1 in 8 Republicans who live in New York City, you can probably win. Because otherwise we got a problem, Julia. We got 4 or 5 banks in New York that have big exposure to rent-stabilized apartment buildings, and they could take a real shellacking.
Yeah. No, I'm going to look up, like, what are the odds right now with Mamdani? Let's see if I can find a market just to see. New York City election, Mamdani at 80%, Cuomo at 10%, Eric Adams at 6%.
That's right.
That's the prediction markets using Kalshi. Huh. Okay, well, so explain the pathway then. I want to hear the path because I think a lot of folks would want to hear that because I think a lot of people they're worried. They think Mamdani is going to win.
Well, and fair enough. The New Yorkers are feeling a lot of pain. The inflation is driving the resurgence of socialist political candidates. But let's remember, this country's been socialist for 100 years. This fascination with Mamdani as a socialist / Marxist, I think is really amusing because if you go back in New York, back to the 1920s and before the early parts of the progressive era, you had people who were far more radical than he is. So I just think, it comes full circle. There is no socialist solution to the high cost of living in New York. I've always said this, we should be evacuating low-income families from New York and resettling them outside the city in communities where they have lower costs, transportation, services. We have that. But everybody likes to live in the city. That's the human tendency.
I think last time I spoke, we talked about it being like a byproduct of inflation. I want to throw another idea out at you with like the rise of like more socialist candidates. When you look at the economy seems quite healthy, right? Markets at all-time highs as well. If you're an owner of assets, it's wonderful. Like you owning homes, right. It's been great. But it does make me wonder, folks that don't have ownership of these assets, so they don't really benefit from this, are we creating like more and more of a wealth divide? And does that also kind of create more of these types of candidates? Yeah, and that's like one thing I keep thinking about.
It's been going on for decades, Julie. Yeah. It's just accelerated since COVID because you had a big uptick in inflation. See, when inflation is a couple % a year, people almost ignore it. They just live with it. But when you get inflation up in the high single digits and it's threatening to go even higher, that becomes a dire threat to people's existence. So even if you just look at inflation over the past year for services, other pieces of the consumer pie, it's gone up a lot and people are hurting. That's why these candidates are getting traction. And I keep saying this to my Republican friends, you have to pay attention to this. Because even though you think you're secure down in Texas and Florida and all the other red states, no, people there are hurting too. And if they hurt enough, they're going to look for alternatives.
Is there anything that the Fed actually can do to solve inflation? Or are we kind of just like stuck at the levels that we're at right now? Like, do their policies really impact
Not realistically. Inflation? I mean, they won't do what they did when you and I were much younger, okay, which was to squeeze the economy until prices fall. Paul Volcker forced down housing prices by putting interest rates up into the teens. This economy would not tolerate that. You'd have banks tipping over. So I think that the Fed's freedom of action is much less than it used to be. They used to take draconian measures. You had Arthur Burns lecturing Congress about deficits and inflation. And he explicitly said, I will not cut interest rates until you reduce the deficit. Would a Fed chairman say that today? No. So that's the difference. People are so much more vulnerable to inflation on the one hand, but the Fed looks at all the debt in the U.S. economy. They look at the Treasury market, which is their primary concern, remember, not inflation, not employment, keeping the Treasury market open. And they say to themselves, we can't squeeze enough to really force the inflation out, because if we had a deflation, guess what? The Treasury market's closed. And if you're borrowing $1 trillion every 3 months, that's not good. So that's kind of where the Fed is. They're in a corner. The Fed is the tail of the doggy, and the doggy is the U.S. Treasury.
And is that even part of their mandate?
No.
That's okay, they're just, they're beholden to it then, but it's not part of the mandate.
That's right. I've been working on the outline for my next book on gold. And it's fascinating to see all of the meetings and the conferences where the U.S. and our allies were trying to say, don't look at gold. The dollar is the reserve currency, yada, 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 right? Well, none of that has worked, because as the U.S. has gotten more and more encumbered with debt, they're forcing our own citizens to look for alternatives. That's why we've seen the rise of Bitcoin and other tokens. It wasn't just the technology that enabled these activities. People are looking for an alternative. They're trying to escape a system they see failing. And that's a very different narrative than we had 20, 30 years ago, when people just assumed that the Fed could play with the buttons and the levers and get the economic outcome that we wanted. We don't have that freedom today. And that's really, I think, the difference for the Fed.
Chris, before I let you go, I have to ask you about the GSEs, Fannie Mae and Freddie Mac, and will they IPO? Trump eyeing an IPO for the GSEs? I want to get your take on the movement that we've seen in that space.
Well, as I mentioned, I picked up some Fannie stock a couple of weeks ago because it had been trading off. We hadn't been talking about it. I think you're going to see a lot of posts on X, the occasional press release from the White House. I don't think you're going to see any real movement on this until the beginning of the fourth quarter, when we're in the next fiscal year. They are still trying to figure this out. Jonathan McKernan, who's been nominated as the deputy for domestic finance at Treasury, he needs to be seated and confirmed by the Senate before he can really engage on this issue. But I think what you're going to see is they're going to try and figure out a way to raise some money. I've written about this extensively. I think they ought to buy back the common and issue a new class of preferred, because they could raise not 30 billion as was alluded to the other day, but hundreds of billions, which is what we need. $30 billion is lunch money in the grand scheme of things right now. The U.S. government needs to raise hundreds of billions of dollars. And I think it's possible. I think Fannie and Freddie ought to be merged. I agree
like Bill Ackman,
totally with Bill Ackman. Yeah, it makes sense. We don't need two of them. And I think they should sell their multifamily portfolio before the offering. Just get it out for whatever you can get for it. They don't need to be in that business. If we're going to subsidize housing, do it at HUD. That's where subsidized housing belongs. So my only concern for Fannie and Freddie is I think their market is going to shrink. I think the conventional market is going to go from 50% of all residential mortgages today, probably down to a third over the next 10 years.
Yeah, why is that?
Inflation. We're driving home prices up, so they're now above the conforming limit, which is about 1.1 million in the high-price markets on the West Coast and the East. And then Ginnie Mae is almost up to 30% of the total market. Why? Because they are a better execution for low-income families. It is absurd to, and the Democrats always do this, to say that Fannie and Freddie should be involved in low-income housing finance. No, they risk price their loans. The best deal a low-income borrower is going to get is from FHA. And that's where any decent loan officer will take them, by the way. There are some lenders in the country, Julia, that won't let their loan officers even show a low-income borrower a Fannie Freddie loan because they know the execution is so inferior. And yet in Washington, they still talk about this. I don't know why.
Do you think, okay, so inflation too would also reduce their market?
Yes.
I mean,
because those loans are rising in value, so
yeah,
they're too big to be financed by Fannie and Freddie. On the other hand, the demand for first-time homeowners and really repeat borrowers, right, is going to FHA because they get a lower coupon. The coupon on an FHA loan is half a point below Fannie and Freddie, right?
which
Pretty
adds up,
easy choice.
Yeah. I was also going to say, I was just wondering, like, yeah, if they'd have to kind of rethink it to even keep up with like the pace of,
They would have to, listen, if they want to stabilize the conforming market, they're going to have to push the conforming limit up to like 1.5 million next year. And they're going to have to be ready to let it rise further. The other issue too, Julia, is remember, Fannie and Freddie don't compete with each other. They compete with JP Morgan. JP Morgan, PIMCO, BlackRock, all these big institutional investors, they're out buying those big loans and they just put them in their portfolio. They don't even need those loans in a security. They just buy the whole loan and hang on to it.
Yeah.
So to me, the competition for that asset is intense. And they're already paying more for those loans than Fannie and Freddie would. So by definition, they're out of the game.
Now, let me ask you this. You said you picked up some of the common shares. Because when people weren't talking about it, and I think there's been quite some volatility in the shares as well this year. Do you want to hold on to those until IPO, or are you just kind of looking at it as like a trade to see?
No, it's a short-term trade.
Okay.
You trade it for the pop. Because what's going to happen is if eventually the government is going to exercise their option, which will get them up to about 80% of all the outstanding shares, but then they have to get paid back for what's called the liquidation preference. So at the end of all of that, federal government's going to own over 90% of the GSEs. And that means the current common, which I own, is going to get diluted 10-1.
Okay, so it's a trade then. I got that. I got it.
It's a trade, Julia.
Yeah, okay. Okay, good to know. Let me see if I can sneak in 2 more questions before you have to run. Is that okay?
Of course.
Okay. It's the question I often ask you, but I just want to get your latest because we're into August. It hasn't been the best selling season for folks with homes. I'm still seeing a lot of homes that have been sitting for 72 days, 100 and something days, like quite a lot of homes that have not moved here that I've noticed personally, like when I'm exercising in the morning. What's your view or outlook on housing as a selfish millennial who would like prices to come down at some point, hopefully soon?
Housing prices are weakening. One of the interesting conversations I had with a big lender down in Florida is that when homes get put on the market there, within a week or two, they're cutting the price because they're not getting any traction. So what I would say is that I think that, we're kind of in a period where home prices have been going up since COVID. They have started to weaken in the past 12 months, a little less. If the Fed cuts rates, though, we're going to see a little boom. Mortgage rates are down to 6.5 now for conventionals. The FHA product is down close to 6. So we're going to start seeing a little refi boom. If the Fed cuts rates a couple of times this year, early next year, we could see that boomlet go through 2026 into 27. And then guess what? My good friend Stan Middleman. Yeah, misery on the 8s. So Stan, I think, is going to end up being right. And he usually is. He's a very smart guy. And, founder of Freedom Mortgage, he has predicted a lot of these turns in the past. And I think in 28, we could see a major housing reset, maybe back down to 2020 price levels. But that'll be a buying opportunity for a lot of families who've been locked out.
That'll be a major reset. Yeah. And you're right, a buying opportunity. Wow.
It won't be the end of the world, but it will cause problems. And let me illustrate one. The market above Fannie and Freddie, what we call jumbo, non or private mortgages, really is the best description, is a very, very fragile thing because the lenders are willing to support that market when prices are stable. But when prices start to come off, the lenders step back and that whole market stops. So if you need a $2 million condo loan or something like that, you got to go to a bank. You got to go to JP Morgan or Wells Fargo or whoever, because the rest of that market's going to disappear. It'll just evaporate. And I am concerned about that because we've seen that twice in the past 5 years, where what we call the non-QM, the non-qualified mortgage market, has just stopped. And that hurts banks. It hurts a lot of different components of the ecosystem for housing.
Yeah. All right. Last question here. I heard you at the top of the conversation mention SoFi as an interesting play. From your vantage point, like, what are the interesting opportunities that you're willing to share or talk about? What are the things that are on your radar right now?
SoFi is an interesting story because they weren't particularly profitable. When we published our bank model at the start of the third quarter, they were way down. They were in the third quartile of our group, top 100 banks, right? But they took off because managers liked what they saw. They liked the fact that the profitability is improving. They liked the fintech cachet, all the rest of it, right? So SoFi just took off, and they've outperformed Bitcoin by threefold this year, which is kind of remarkable. The other one that's back from the dead is Lending Club. Lending Club started to make money. Yeah. They did a deal with BlackRock. They're actually selling BlackRock issued debt with a rating from Fitch Ratings on their platform. That tells you what investors want. They want safe income. So I think what I would say to you is that don't necessarily discount some of the dogs, if you will, of the Dow, if you remember that old term.
Oh, yeah.
Because sometimes they get up and they start running. Now, most of the top performers, we actually, had identified: Axos, JP Morgan, American Express, Schwab, which I love. I think that's a great story.
I know you do, yeah.
Citi has come galloping back too, hat tip to Jane again, right? But Citi also still has a lot of noise around the stock because of their global footprint. We just found out they were managing a trust for somebody who's on the sanctions list. So that's always a caveat with Citi. But, I think Jane Fraser's made a lot of progress.
Mm-hmm. All right. I lied. I want to ask one more. What is the biggest risk for you right now? What's the biggest risk for you right now that's maybe keeping you up at night that you're thinking about? And what is something that is making you really optimistic?
Well, I think the next risk to the markets is probably going to come from the world of coins. These platforms that have been erected recently, these second and third level platforms, where essentially we're trying to lock people in to ownership of these tokens to keep the prices up. The rate of appreciation for many of these ersatz assets has slowed down dramatically. If you look at the rate of change in Bitcoin, it has slowed down dramatically. So I think we're kind of at the end of the story here. I'm not a big fan of stable coins. I think they're basically prepaid gift cards with expensive fees. Will we have stable coins a year or 2 years from now? Yeah, Amazon, Apple, people like that are going to issue them at a discount to get customers. But remember, it's about the ecosystem, Julia. It's not about the asset. It's about how many customers you can capture and keep. So I think that, despite the support from Trump, despite all the politics of this, the coin phenomenon is going to run out of gas pretty soon. And I worry about that because, again, if we have a surprise that no one is anticipating, that's what would cause a lot of volatility in the markets. I'm optimistic, though, because I think a lot of the things that President Trump are doing are great. He occasionally is a little bit erratic and volatile himself, but overall, I think they're doing a good job. The politics do worry me, though. They're replacing a lot of people in Washington that may or may not have the subject matter expertise to do the job they need to do. So I do worry about that a little bit. But, overall, I think we're much better off than we were 2 years ago.
Yeah. Chris, are you a Bitcoin guy?
No.
Do you own any? No. Okay.
I have never owned any coin. Why? I would rather trade stocks. Stocks have more liquidity.
Yeah. Makes sense. Chris Whalen, chairman of Whalen Global Advisors, author of the Institutional Risk Analyst blog, and author of Inflated Money, Debt, and the American Dream. Go pick up your copy today. I will link it in the show notes and the audiobook. It's coming out soon. If you're an audiobook person, be on the lookout there. Chris, really appreciate you. I always enjoy having our conversations every month. This audience loves you, and we look forward to seeing you in September.
Yes, Julia, we'll do a studio interview soon.
Oh, you know what? I am going to be there for FOMC day in September, so maybe we can do it around that time.
There you go.
I don't know. If you're around, I'll ping you and we'll figure it out. It'll be awesome in person.
Thank you,
Looking
Julia.
forward to it. Thanks, Chris.